Hey, good morning, guys. If you're thinking about buying your first place, you've probably heard people mention fixed rate and variable rate mortgages. But what do they actually mean? What's the real difference between the two? And most importantly, which one is better for you? That's what I'm going to unpack here in today's video. I'll walk you through the pros and cons of each. I'll share a few things that most banks don't really explain. And so by the end of this video, you should have a better understanding about which option is going to make the most sense for your situation. Let's start with fixed rate. Fixed rate mortgage, your interest rate stays the same for the whole term. There's no surprises. Most people in Canada choose a 5-year term because it gives you a nice balance between steady payments and easy budgeting. And you're not locked in forever if life happens to change or rates drop. Your monthly payment won't change, which makes planning simple and straightforward. And honestly, that peace of mind can go a long way. If you're already stretching to make things work, not having to worry about rates jumping next month or next year is huge. So fixed rate mortgages can be a great option if you're the kind of person that wants to set it and forget it, or if you just prefer fewer moving parts. Then you've got variable. Variable rate mortgages work a little bit differently. With variable, the rate can go up or down depending on what the Bank of Canada decides. Every 6 weeks, the bank comes together to review something that's called the overnight lending rate, which influences the prime rate your lender uses. So if the Bank of Canada decides to raise or lower their rate, your lender's prime rate usually follows. And that's what's tied to your variable mortgage. Now, in Canada, we have two kinds of variable. First is an adjustable rate. This is where your monthly payment changes when the rate changes. And then we have variable with fixed payments. This is when your payment stays the same, but what actually happens behind the scenes changes. When rates go up, more of your payment goes towards interest. When rates go down, more of your payment goes towards paying off your mortgage or paying down the principal. So variable can be a smart option if you have some breathing room in your budget, if you're planning to maybe move, refinance before your term is up, or if you think rates are going to drop and you want to ride that wave. But, and this part does matter, if you are already stretched each month, a variable rate mortgage can put you in a tough spot pretty quickly. You don't want to be caught off guard if rates climb unexpectedly. Something a lot of people don't really talk about enough, I think, are penalties on mortgages. In Canada, if you break your mortgage before the term is up, which honestly, a lot of people do, you'll more than likely pay a fee. With a fixed rate mortgage, that penalty is usually based on something called the interest rate differential. And depending on your lender, these can get pretty expensive. We're talking $10,000 or more in some cases. Whereas with a variable rate mortgage, it's usually just 3 months interest. That's it. Way cheaper. So even though fixed rate might feel safer, it could actually end up costing you more if you need to get out early. And if you're buying a starter home or think that there's even a chance you'll move, you'll refinance before your term is up, that's something that you and your family want to seriously factor in. If you think most people ride out the full term of their mortgage, it's not necessarily true. Industry data suggests that about 60% of Canadians break their mortgage early. This could be for a move, a separation, debt consolidation, maybe a refinance. Life happens, shit happens, and it happens a lot more than most people expect. So yeah, breaking your mortgage isn't super rare. And that's exactly why it's so important to understand your penalties and the differences between fixed and variable rate mortgages, because the difference can cost you thousands of dollars. All right. So now that we've talked about penalties and flexibility, let's get to answer the question that everyone wants to know. What's actually cheaper? Well, over the past couple of decades in Canada, variable rate mortgages have come out ahead more often than not. So people who went with a variable typically saved more in interest over time. But today is different. Rates aren't exactly the highest they've ever been, because back in the 80s, they actually went to over 20%, but they're definitely higher than what we got used to in the COVID era of 2020 and 2021, when the Bank of Canada dropped rates to basically zero to keep the economy going. Since then, they've been raising rates to try to slow down inflation. And by, I think, mid-2023, the overnight rate hit 5%. But if there's one thing that we know for sure right now, it's that nothing is predictable. 1 month, inflation cools. The next, it ticks back up again. The Bank of Canada is watching every data point closely, but really, nobody knows what they'll do next. So if you're the kind of person who follows rate updates and doesn't mind a little bit of uncertainty, variable rate mortgage might be worth a look. But if you like knowing exactly what your payments will be month in, month out, fixed rate mortgage could offer you the peace of mind that you're looking for. And honestly, that kind of peace of mind, that kind of stability can matter more than chasing a slightly lower rate, especially when your budget's tight and life's already full of surprises. At the end of the day, it's not just about the math. It's about what actually works best for you and your family, because there's no one-size-fits-all answer here. It depends on things like your income, your cash flow, how comfortable you are with risk, how long you plan on staying in the home, and whether you plan to move, plan to refinance, or make changes during the term of your mortgage. Some people will go with fixed, some people will go with variable, and some do a split, part fixed, part variable, to hedge their bets. It's not about what's trendy, it's about what fits you. A mortgage isn't just about locking in the lowest rate either. It's about setting you and your family up for success, not just for today, but for 5 years from now. If you're feeling unsure, overwhelmed, that's totally normal. This stuff isn't supposed to be obvious. That's why mortgage brokers, people like me, exist. If you want someone to walk through your options, break it down in a very simple, clear way, reach out. My information is in the links below, and I look forward to speaking with you.